Welcome to another session of the My Solo 401k Financial YouTube and LinkedIn webinar series. We're waiting for the viewers to join and confirming the audio. We'll be getting started momentarily. In the meantime, if you could please like this video and subscribe, we'd really appreciate it. Okay, there's the audio. Audio looks good or sounds good. So we'll jump in with today's presentation. Again, we're on our YouTube channel, on LinkedIn. The topic today is continuing our deep dive discussion of the solo 401k contribution rules for 2021 and 2022. And we're focused on the rules for businesses that are taxed as a sole proprietorship, a single member LLC, or a 1099 independent contractor. Again, if you could please like and subscribe if you're on our YouTube channel, that would be great. You're going to be able to come back later and watch the recording if you can't stay for the whole session. So this presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Before we jump into it, we want to also highlight our community, as it's a great resource. For example, we have webinars every day of the week in our community. It's free to join and all are welcome. There's the link to that. It's mysolo401k.net/my community. So for example, tomorrow on the community, we'll be hosting or continue to discuss the contribution rules with the focus on Mega Backdoor Roth contributions, again, for sole proprietors, single member LLCs, 1099 independent contractors. That'll be at 1 p.m. Pacific, 4 p.m. Eastern. On Friday, we'll be back here on the YouTube and the LinkedIn channels to continue that same Mega Backdoor Roth discussion. So again, we host webinars every day, daily live webinars where you can come and ask questions. You can hear what other people are asking to join the conversation. 24/7, you can also post questions in our forums. As you can see, we're fielding questions here throughout the day. You can see what other people are asking. You can post your own question. Just click create post. So that's another great way to learn and to build into also continue the conversation in the forum. Learn from others and ask your own questions. So as far as the agenda for today, we're going to talk about the contribution limits in terms of the rules, etc. We're going to apply those rules with different scenarios to see how it works. We're going to take a look at our online calculator to see how to use that online calculator. And we're going to talk about the mechanics. So the deadline to make contributions, how to make contributions, how to report contributions, what is not a contribution. So let's jump in because there's a lot of ground we want to cover. So, and again, we're focused today on sole proprietors, single member LLCs, individuals who are reporting their self-employment income on Schedule C of their 1040, such as independent contractors. We have other content on our website for other types of self-employed businesses, such as partnerships, such as S corporations and C corporations. So anytime you discuss how much you can contribute to a solo 401k, we want to recognize that the ability to contribute to the plan is based off of different factors. So we're going to go through each factor and talk about that in detail. But number one, your self-employment income. So you cannot save more than you earn. So the whole point of a 401k is for specifically a solo 401k is for a self-employed individual to save their earned income. So you have to have that earned self-employment income to justify the contribution. Another important factor is your age, because once you're 50 or older, you're going to be able to make what is called catch-up contributions. So we'll talk about how much those are and how that works. when we go through the rules and the scenarios. Whether you participate in another retirement plan, such as a 401k plan through a day job. We have a lot of clients and members of our community that have a W-2 job, even participate in their W-2 employer-sponsored plan, but also have a side business for which they have a solo 401k, into which they want to make solo 401k contributions. So we'll address that scenario when we talk about the contribution rules in these slides coming up. And then finally, the type of contribution. So when you're self-employed, you can make multiple types of contributions. You can make employee as well as employer, because you're both the employee and the employer when you're self-employed. And if your plan allows it, like ours does, you can make pre-tax, Roth, and even voluntary after-tax contributions. But the rules will, how much you can contribute will depend on what type of contribution you're looking to make. So let's dig a little deeper in terms of what is self-employment income for a business that's taxed as a sole proprietorship, a single member LLC, or a 1099 independent contractor, where you're reporting that earned self-employment income on Schedule C of your 1040. In that case, your ability to make solo 401k contributions is based off of your net income, so after expenses, etc., that you claim related to your self-employment activity, less 1/2 of the self-employment tax. So you need to run a pre-calculation. Line 31 is Schedule C, less 1/2 of the self-employment tax. Keep in mind that you cannot use W-2 wages from other sources like a day job. You also can't consider investment income, such as investment income reported on Schedule E of your 1040. So again, the starting step is to calculate the self-employment compensations. That's that net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. Our online calculator will run that calculation for you. And we'll talk about that calculator in detail in a few slides that are coming up. The next consideration is determine, okay, what year are you looking to make contributions for? So we have a lot of people who are still making contributions for 2021, because as we will see when we look at the deadline, there's still time to make 2021 contributions. But the limit increased from 2021 to 2022. So it went up from $58,000 to $68,000. Excuse me, from $58,000 to $61,000 for 2022, plus an additional $6,500 if you're 50 or older. So for 2021, you could contribute, if you have the self-employment income to justify it, as much as $64,500 if you're 50 or older. And for 2022, as much as $67,500 if you're 50 or older. Next, you need to determine the contribution type. As I mentioned, you can make both employee and employer contributions to a solo 401k. And within the employee contributions, you could be making those contributions, again, if your plan allows it, like ours does, as a pre-tax, Roth, and or voluntary after-tax contribution. Employer contributions are always pre-tax contributions. Now, when we go through these rules, we'll note that if you are making contributions to another plan, that'll reduce how much you can contribute as an employee, because that employee contribution limit applies at the employee level, whereas the employer contribution limit applies at the employer level. So even if you've already maxed out contributions to your day job, say 401k plan, you could still be making employer contributions to the solo 401k. And that rule about not having to aggregate for employer contributions also extends to voluntary after-tax contributions. So let's dig a little deeper into these rules to see how they really work. And then we'll go through the scenarios to apply the rules to see how much you can contribute based on different scenarios. So the first limit we're going to talk about is the employee limit. Employee contributions are also referred to as salary deferrals. So the limit is 100% of your self-employment compensation, dollar for dollar, up to $19,500 for 2021 or $20,500 for 2022, plus, if you're 50 or older, an additional $6,500 for each year. Now remember, self-employment compensation is the product of that pre-calculation. Line 31 of Schedule C, less 1/2 of the self-employment tax. Also keep in mind that the employee limit applies at the employee level. So if you are making contributions to another plan, such as the day job 401k plan, you would have to reduce how much you can contribute to the solo 401k as an employee contribution. The one exception to that rule is if the other plan is a 458 governmental plan. In that case, contributions are not aggregated. Next, you could choose to make that employee contribution as a Roth contribution, assuming that you have a plan like ours that allows it. So you can make the entire employee contribution as a pre-tax, or you can make the entire employee contribution as a Roth contribution, or you could do a mixture, some of each. If you choose to make Roth contributions, those contributions need to be deposited in a separate sub-account for each participant. So when we go through the end of the slide, we'll have some illustrations to show how the multiple sub-account setup might look. All right, next, let's talk about the employer contribution limit. So employer contributions are also referred to as profit-sharing contributions. It's a synonym. And remember, employer contributions are always pre-tax contributions. There's no such thing as a Roth employer contribution. So the employer contribution limit is 20% of your self-employment compensation when you're taxed as a sole proprietorship, a single member LLC, a 1099 independent contractor. So you've got to run that pre-calculation, line 31 of Schedule C, less 1/2 of the self-employment tax. Of that number, you can contribute 20% as an employer pre-tax contribution. Now keep in mind that the sum of all the contributions that you make to the solo 401k, employee, employer, and or voluntary after-tax contributions can't exceed the overall limit. So again, for 2021, the overall limit is $58,000 or $64,500 if you're 50 or older. For 2022, the limit went up to $61,000 or $67,500 if you're 50 or older. And the employer contribution limit applies at the employer level. So it's not impacted by contributions that are made by you or on your behalf to a retirement plan through an unrelated employer, such as the day job 401k plan. Now that's exception to the rule that you don't have to aggregate with contributions made to another retirement plan sponsored by an unrelated employer. Doesn't apply if the contributions were made to a 403b. So if contributions are made to a 403b by you or on your behalf, you do need to aggregate those contributions with the contributions made to the solo 401k to confirm that the total contribution amount doesn't exceed the overall limit. Last, we'll talk about the voluntary after-tax limit, and then we'll talk about this. We'll go through scenarios to see how it all works. So voluntary after-tax contributions are how individuals are making so-called Mega Backdoor Roth contributions. Because as we'll see, the limit is higher. The voluntary after-tax limit is higher than the Roth solo 401k limit. Remember, the Roth solo 401k limit is really that employee limit. So $19,500 for 2021, $20,500 for 2022, or an additional $6,500 if you're 50 or older. The voluntary after-tax limit is the lesser of your self-employment compensation and the overall limit. So that means you can contribute 100% of your self-employment compensation, dollar for dollar, up to the overall limit, 58,000 for 2021, 61,000 for 2022. Now, you do need to reduce by any other employee or employer contributions made to the plan. So you don't have to reduce by contributions made to another plan, like a day job plan, unless the other plan is a 403B, but you do need to reduce by any employee or employer contributions that you make to the solo. Note that the limit doesn't go up if you're 50 or older, so it doesn't go up by 6,500 if you're 50 or older, but you also don't have to reduce how much you can contribute as a voluntary after-tax contribution by any catch-up contributions made to the plan. So ultimately, you can get to the same place. You can still get to the 64,500 or the 67,005 for 2022, but you would make that catch-up contribution not as a voluntary after-tax contribution, but instead as an employee contribution. And we'll see when we look at the scenarios how this might work. Lastly, just like the Roth contributions need to be deposited into a separate sub-account for each participant, likewise, voluntary after-tax contributions need to be deposited into a separate sub-account for each participant. So this is how one might have 3 different sub-accounts: pre-tax, Roth, and voluntary after-tax. And 6 different sub-accounts, like say if you have 2 participants, such as a husband and wife, both participating in the same solo 401k. When we look at the illustrations, we'll see how this might play out. So now we're going to turn to some contribution scenarios to see how these rules apply. What we're going to do is we're going to set a baseline scenario, and then we're going to tweak each of the elements one by one to see how it impacts how much we can contribute. So for our baseline scenario, we're assuming that this individual is taxed as a sole proprietor, a single member LLC, or a 1099 independent contractor, where this person is reporting their earned self-employment income on Schedule C of their 1040. We're assuming it's just one participant who's under 50 years of age, who does not make contributions to another plan, like a day job plan, where the goal is to first maximize the pre-tax contributions and then make Roth and or voluntary after-tax contributions. Finally, we're assuming this individual has $100,000 of self-employment compensation, where again, that's line 31 of Schedule C, less 1/2 of the self-employment tax. So this person is going to be able to contribute 100% of that self-employment compensation, dollar for dollar, up to $19,500 for 2021 or $20,500 for 2022 as a pre-tax employee contribution. Next, they're going to be able to contribute 20% of that self-employment compensation figure, or $20,000, as an employer contribution. And remember, employer contributions are always pre-tax contributions. Finally, this person will be able to contribute the difference up to the overall limit. So that's $18,500 for 2021 or $20,500 for 2022 as a voluntary after-tax contribution. And then they can move the money from the voluntary after-tax sub-account to the Roth solo 401k sub-account. So at the end of the day for 2021, they could have $39,500 in their pre-tax solo 401k sub-account and $18,500 in their Roth solo 401k sub-account. For 2022, they would have $40,500 in the pre-tax account and $20,500 in their Roth solo 401k sub-account after making that Mega Backdoor Roth contribution. Because remember, the voluntary after-tax contribution limit is 100% of the self-employment compensation, dollar for dollar, up to the overall limit, but reduced by any other employee or employer contributions made to the plan. So let's tweak one of the assumptions. So instead of $100,000 of self-employment compensation, let's assume this person has $50,000 of self-employment compensation. Remember, self-employment compensation, when your business is taxed as a sole proprietorship, a single member LLC, or a 1099 independent contractor, is line 31 of Schedule C less 1/2 of the self-employment tax. So this person can contribute the same amount as an employee pre-tax contribution. For the employer pre-tax contribution, it's going to be a lower amount because it's 20% of a smaller number, 50 instead of 100,000. So that means $10,000 as an employer pre-tax contribution. And then they're going to be able to contribute the difference up to 50,000, right? Because you can never contribute more than your self-employment compensation. You can't save more than you earn. So that means they'd contribute the difference as a voluntary after-tax contribution. That would mean $20,500 for 2021 and $19,500 for 2022. So now let's go back to the baseline. We're back to making $100,000 of self-employment compensation. But now let's assume that this individual maximizes contributions made to the day job. So they put in $19,500 as an employee contribution for 2021 or $20,500 as an employee contribution for 2022. So this means that the person is not going to be able to make any more employee contributions to the solo 401k. So this scenario is a good illustration of how the employee contribution limit applies at the employee level. Since this individual already went up to the limit under the day job plan, they can't make any more employee contributions to the solo 401k. It does also illustrate, though, that the employer contribution limit, as well as the voluntary after-tax contribution limit, is not impacted by contributions made to a day job 401k plan. So they could still contribute $20,000 as an employer pre-tax contribution, 20% of their self-employment compensation, and now they can do the difference up to the overall limit, $38,000 for 2021, $41,000 for 2022 as a voluntary after-tax contribution, and then move the funds over to their Roth solo 401k sub-account. So now let's go back to the base. Let's assume this person doesn't make contributions to another plan. They still have $100,000 of self-employment compensation, but now their goal is they're not interested in making pre-tax contributions. So they want to maximize Roth and or voluntary after-tax contributions. So instead of making that employee contribution as a pre-tax contribution, they'll make it as a Roth contribution, $19,500 for 2021, $25,000 for 2022. They'll skip the employer pre-tax contributions because those are always pre-tax contributions and they're not interested in making pre-tax contributions. So they'll simply make the difference up to the overall limit, $38,500 for 2021, $40,500 for 2022 as a voluntary after-tax contribution, and then move the funds over to the Roth solo 401k. So now at the end of the day, they'll have $58,000 in their Roth solo 401k sub account for 2021 and $61,000 in their Roth solo 401k sub account for 2022. So now let's go back to the base, same initial scenario, but the only difference is that there's now two participants. Let's say it's a husband and wife, both working in the same business. Let's say they're both realtors and they both have $100,000 of self-employment compensation. So what changes, if anything? Well, nothing changes. They can still contribute the same amount. This scenario illustrates how the ability to contribute to the plan depends. It's based on the participant's level. So based on each participant's age, each participant's self-employment compensation, whether each participant makes contributions to another retirement plan. So in this scenario, since each participant, the husband and wife, are both in the same boat, they can both contribute the same amount, right? They both have the same compensation, age, etc. So now let's go back to the base, back to one person, 100,000, but let's assume that the person is 50 or older years of age. So what changes, if anything? Well, nothing changes other than the fact that now this person can make a catch-up contribution, an additional $6,500. So this is a great slide in that it illustrates that the catch-up contribution is made as an employee contribution. So now they're making, for 2021, $26,000 as a pre-tax employee, and for 2022, $27,000. This is also a great illustration of how the voluntary after-tax contribution limit doesn't go up when you're 50 or older, but you don't have to reduce how much you can contribute as a voluntary after-tax contribution by the catch-up contributions made to the plan. So you still end up in the same place. In some, you're still making $64,500 for 2021 or $67,500 for 2022. So now let's go back to the base. Let's assume that the person maximizes to the day job plan, but they're not interested in making pre-tax contributions. So this person is not going to be able to make any employee contributions to the solo 401k because they've already hit the limit by the contributions made to their day job plan. They're not interested in making employer contributions because employer contributions are always pre-tax contributions. So this means that they make the entire amount as a voluntary after-tax contribution, $58,000 for 2021, $61,000 for 2022. So now let's go back to the base. Same scenario, except the only difference is this person's 50 or older, but they're still maximizing the employee contributions to the day job plan. So what changes, if anything? Nothing. They still can't make employee contributions. They still don't want to make employer contributions. So they just make the entire amount as a voluntary after-tax contribution. So this is a good scenario in that it illustrates that the voluntary after-tax limit doesn't go up when you're 50 or older. Okay, so let's go back to the base. So we've got two participants. Each person maximizes contributions to the day job plan. Each person has $100,000 of self-employment compensation, and each person's only interested in Roth and or voluntary after-tax contributions. So the amounts are not changing. What this is illustrating is that the ability to contribute to the plan is based off of each person's situation, each person's compensation, age, etc. So each person is not going to be able to make employee contributions because they already hit the limit under the day job plan. They're not interested in making employer contributions because employer contributions are always pre-tax contributions. So they make the entire amount as a voluntary after-tax contribution. So that takes us to the end of the scenarios. So now we're going to take a look at the mechanics of making contributions. So one last point before we really dive into that is just how to use our online calculator. So this is a tool that's on our website 24/7. If you go to mysolo401k.net, there's a drop-down menu under Learn. If you click on Online Tools and click through, you'll get to the online calculator. So once you get to the online calculator, for a business that's taxed as a sole proprietorship, a single member LLC, or a 1099 independent contractor with the income reported on Schedule C of your 1040, you would select unincorporated sole proprietorship as the business type. For net income, enter the amount from line 31 of your Schedule C. The calculator will run the pre-calculation for you to reduce the amount by 1/2 of the self-employment tax. Next, you'll enter the age of the participant as of the end of the applicable year. Now, note, you're going to be able to view the report, view the detail, print it to keep a copy for your records. The calculator doesn't contemplate a scenario where someone is making contributions to a day job plan. It doesn't contemplate a scenario where you're looking to make after-tax contributions. So you would need to modify for these scenarios. So once you know how much you can contribute, how much you want to contribute, it's time to make the contributions. So in the next few slides, we're going to go through the detail, deep dive, the different mechanical steps of making those contributions. So how do I make the contributions? You can make the contributions by check. You can make the contributions electronically. If you wish to make the contributions by check, simply write a check payable in the name of the solo 401k and write annual contribution on the memo section of the check. If you want to make the deposit electronically, that's fine from a solo 401k perspective. You'll want to check with the financial institution that holds the accounts. We help our clients establish an account as part of the onboarding process or accounts at the bank or brokerage of their choice. We have clients at hundreds of different banks, different brokerages. For the brokerages, the general rule is that they will not accept an electronic deposit from a third-party account where the name on the external account doesn't match the name on the account at the brokerage, meaning it's not an external account in the name of the plan. The one exception is Fidelity, where they will allow you to make an electronic deposit from an external account where the name on the external account doesn't match the name on the account at Fidelity. If you have multiple participants, each participant will deposit his or her contributions into separate sub-accounts. If you're looking to make different types of contributions, pre-tax, Roth, or voluntary after-tax, likewise, those need to be deposited into separate sub-accounts. You can make the contributions in one lump sum or a series of contributions. You can make the contributions from a personal account or a business account. All is acceptable from a solo 401k perspective. Now, when is the deadline to make contributions? It's clear based on IRS Publication 560, which is the landmark guidance for self-employed retirement plans like a solo 401k, that as long as the plan was established by the end of the year, you would have preserved the right to make all types of contributions, employee, employer, voluntary after-tax contributions, anytime up until the business tax return deadline, including any timely filed extension. There's a chart on page 3, which we have a snippet of here, which makes that crystal clear. So for 2021, when your business is taxed as a sole proprietorship, could be an LLC or just a business that doesn't have a formal legal entity, that means that your deadline is really your 1040 deadline. So that's April 15th or October 17th if you file a timely extension. For 2023, it's going to be, if you set up the plan by the end of 2022, you have until your business tax return deadline, including any timely filed extension in 2023, to make the contributions. So that means April 17th of 2023 or October 16th of 2023 if you file a timely extension. Now, how do I report the contributions? It depends on what type of contribution you're referring to. So for pre-tax employee contributions, employer contributions, which again are always pre-tax, you'll report those contributions on line 16 of the Schedule 1 of your 1040. Employee Roth contributions, voluntary after-tax contributions are not reportable when your business is taxed as a sole proprietorship, an LLC, single member LLC, or independent contractor, where you're reporting that income on Schedule C of your 1040. Now, we do note that voluntary after-tax contributions, again, the contribution itself is not reportable. But later, when you move the money from the after-tax sub-account to either a Roth solo 401k or Roth IRA, that move is reportable. The transfer is reportable on a 1099-R. So indirectly, those voluntary after-tax contributions are going to be reported. So what about matching contributions? This is a common question that comes up, right? Because a lot of people have learned about 401k plans from a day job, right? A job where they have a 401k and they might have matching contributions. So matching contributions only apply to a full-time employer plan. They do not apply to a self-employed solo 401k plan, a 401k plan where it's really an owner-only business. Solo 401k contributions, as we learned, only consist of employee and employer contributions. So matching is when the employer matches what the employee has contributed. As we saw, you can make employer profit-sharing contributions to the solo 401k, even if you're not making employee contributions, right? Because you might have hit your limit under your day job plan. So that's great that it's not contingent on having made the ability to make employer contributions to the solo 401k is not contingent on whether you've made employee contributions to the solo 401k. But in sum, matching contributions doesn't apply to a solo 401k. So we also receive common questions about other types of funds that are being deposited into the solo 401k and whether that's considered to be a contribution that is therefore subject to the contribution limits. So these amounts here are not contributions and therefore not subject to the contribution limits, right? Amounts that you roll into the plan from an existing retirement account, such as a former employer plan or non-Roth IRA. As part of our onboarding process, we're helping our clients roll over money from their pre-existing retirement accounts. Obviously, funds are being deposited into the solo 401k, but that's not considered a contribution. It's not subject to the contribution limits. Earnings from your investment. A very common use case is cryptocurrency, real estate. Let's take real estate. You might have a rental property held inside your solo 401k where the tenants are writing checks to the plan to pay the rent. Obviously, funds would be deposited into the solo 401k, but that's not considered a contribution. It's not subject to the contribution limits. Amounts converted within the plan, right? You might move money from a pre-tax solo 401k status to a Roth solo 401k status, or with the Mega Backdoor from the after-tax sub-account to the Roth solo 401k sub-account. Of course, that means that funds are deposited into the Roth solo 401k sub-account. But that transfer, that conversion is not considered a contribution and therefore not subject to the contribution limits. Lastly, solo 401k participant loans, one of the most common use cases where you have the ability with our plan to borrow up to 50% of the balance, not to exceed $50,000. And we prepare the required loan documents as part of our service for no additional charge. So of course, that means you're going to have to make those payments back to your 401k account and funds will be deposited. But that repayment of that 401k loan is not considered a contribution and therefore not subject to the contribution limits. So that takes us to the end of the slides that we wanted to share. Thank you so much for the participation. Please continue to engage. We would appreciate it if you would like and subscribe to our YouTube channel. It would be great if you would participate in our community as well. Again, we have, it's free to join. We have forums, we have daily webinars where you can join the discussion, you can learn from others, you can ask your own questions. The URL is mysolo401k.net/mycommunity. So here's the page. You can see that we've got some upcoming webinars here. We've got our forums where folks are asking questions throughout the day and we're responding throughout the day. So it's a great way to see what other people are asking about and discussing and even post your own question. We do have a little bit of time if there are any follow-up questions on what we discussed. All right, well, that looks like it takes us to the end, so we'll call it. Again, thank you so much for the participation and all the best.